Happy New Year, everyone. 2012. This is Ron William, technical strategist from MIG Bank. It is truly an honor and a pleasure to be sharing time with each of you today. The first webinar from MIG Bank for 2012, the new year. And the webinar today is successful trading in the volatile year of 2012. And so that's the title. And one of the just housekeeping guidelines I always highlight is in terms of questions and maybe contact details that you would like to follow up with me. If there isn't enough time to answer questions, please write down my email address, r.william@migbank.com. MIG Bank also has social media sites on Facebook. I have a Twitter account, rwilliam77, and also you can find me on LinkedIn under Ron William. Lastly, forexstreet.net. On an ad hoc basis, I update a blog on forexstreet.net, which is part of the FX Street offering. Okay, let's start. So for those of you that maybe are new to this webinar session with me, we've been holding this every month for over a year now, myself personally. And I always start by giving a quick introduction on myself, but more specifically on the trading strategies that I've used for many years. Now, I've been in the industry for well over 10 years professionally, working with various institutions, developing trading strategies, both short-term and long-term. And during that time, the three areas which I focus on the most are on the screen at the moment. First, market cycles, which is just basically understanding a potential roadmap, a probable roadmap for market moves into the future. This is focusing mainly on time cycles, but also economic correlations, for example, different asset classes like the US dollar with gold, for example. Second and third area actually is focusing more on market timing, more short-term market timing, and that is pattern analysis such as Japanese candlestick trade setup. This is something I specialized in from the very first day that I started in the market. And Japanese candlesticks is a great way to understand market psychology, but also keep in mind that you're able to take advantage of very fast-moving trade signals in a matter of one trading session to 2 or 3 trading sessions. Think how long it takes for a chart pattern or maybe economic news headline to actually give you that confirmation of a potential trade setup. And then part of that market timing focus of mine is in the advanced indicators that I use, most notably DeMark indicators, which some of you may be aware of, developed by Tom DeMark, a very well-known investor and trader for over 40 years. And he's developed many indicators which are counter-trend in nature, so they look for exhaustion in trends. And so by definition, you're always looking for the end of the trend, or you're looking for turning points in the market. So that's pretty much the three key areas I focus on. Of course, there's many other things that I've looked at over the years, but these are maybe the central focus points. Now, before I get stuck into the core of this webinar discussion, I always like to ask the question to each of you here from so many different countries around the world. How many of you are attending this webinar for the first time, or this is you've attended other webinars that I've given, and where in the world are you from? Each of the webinars we've given at FX Street have been truly global webinars, and so I always like to have an idea. So how many of you have attended webinars, yes or no, and which country are you from? It's also a great way for each of you to network with each other. I think there's quite a few people that signed up for this webinar this month. So we have returning customer from Canada, Philippines have attended your webinars before, Canada, but never been here before, Poland, first time, USA, first time, Japan, first time, England, Phoenix, Arizona, Slovenia, Arizona. Regular attendee from Miami, Florida today. Sounds great. First time from Spain, USA. Anyone else? Portugal, third time. So we have a big kind of multicultural group here. South Africa, Poland, Great Britain, and some of the countries that I've already mentioned. So I'll let that continue. Mexico, I'll highlight that. We have a few people from the Americas. Okay, well, I'll let that continue in the background so each of you can maybe just introduce yourselves in terms of whether you've attended these webinars or not before, and which country you're from. It is tradition for me to welcome all of you, attendees that have attended each of my webinars. Thank you so much for your kind support, and I hope the knowledge that we've shared together has been useful and allowed you to maybe make some successful trading strategies in recent months. And to the new people here, big welcome, and I hope that you can attend future webinars that we give here at MIG Bank, and certainly the ones that I give each month. It's very much an interactive webinar, so please feel free to ask questions throughout the webinar. And if we run out of time at the end, please feel free to send me emails. I answer pretty quickly on my emails or various Twitter and blog accounts that I hold. Okay. Just a quick disclaimer, no information published constitutes a solicitation or offers a recommendation to buy or sell. This is just informational and educational purposes only. I'm obliged to kind of just quickly show you this slide for legal purposes too. Okay, now there are usually 3 parts to all of the webinars that I give, and today we are talking about successful trading strategies in the potential volatile year of 2012, this new year that we have just entered. And part 1 is talking about the volatile year of 2012. Part 2, New Year resolutions. It's just I've just recently added this section in, which is more focusing on what are your New Year resolutions. I was asked by the FX Street team to actually contribute my own New Year resolutions as a trader, and I will share with you some of those thoughts, which focus on timing, psychology, and various risk scenarios that might unfold into this year. Part 3 is something I call pyramid analysis. Some of you who have maybe attended previous webinars might have an idea what I mean when I say that. It's just my way of teaching a step-by-step process of analyzing the market. But what I'm going to do is actually teach you the adapted way of analyzing markets, which are volatile. So that's what we're going to cover. Part 1, I'm going to do a quick sentiment survey because I just want to know what each of you feel about 2012, whether you're bullish or bearish, and then I shall give you my perspective, and then we'll follow up into trading strategies in part 2 and part 3. Okay, so the very first stage of this webinar, I just want to start this new year, the very first webinar of 2012, asking each of you, how do you feel about 2012? The weeks that have passed and the weeks ahead, and certainly today with the breaking news that we've had in the Eurozone, potentially positive news in Greece in terms of reaching a deal, and some geopolitical risk coming out of European nations vis-a-vis a potential European-Iranian oil embargo. So quite a few big things happening. And of course, we have the election year, U.S. elections this year, which most people are seeing as a positive. So I've just given a quick kind of reasons and clues as to what's happened today and what might be on your mind. But how many of you are bullish into 2012 and why? And how many of you are bearish into 2012 and why? So if you could just quickly say bullish and bearish and give each of us a quick reason as to why you're bullish or bearish. It might be a technical reason or it might be an economic reason, and it might be a certain regional focus that you have. So are you bullish or bearish in the Western market versus Eastern market? Are you globally bullish, globally bearish? But most importantly, tell me why. So some people are saying bullish on the euro. One person saying bearish followed the last 7 months, election year. Someone's saying it would be too volatile to hold an opinion for long, so neither for me. A very good point. Bearish state of world economy. Bullish on euro. Or bullish euro problem will be solved. Bearish macro fundamental reasons. So there's quite a few points in there. Bullish and bearish, play it day by day. So it also depends on what type of mandate you have, whether you're a short-term trader or whether you're a long-term investor. Bullish except US dollar because of QE3 potential lurking. Neither price action will dictate. It's a very good point. Let the market tell you where it wants to move. Bullish on euro for the next 3 months because it's very oversold. Agreed, it's a very good point. We have unwound from historic 1 year oversold levels if you look at liquidity positions on euro. Does not matter, make money either way. I shall end off on that point. Great participation there, and I hope FX Street team can maybe do a quick snapshot of the forum just so we can get a good idea of the ideas which are being shared. Keep in mind that each of you are traders and investors in the market around the world, and you represent pretty much the sentiment out there. So it is very important to share your ideas and your opinions, because that says a big thing about what other people might be thinking in the market. And so the question is, are you bullish into 2012? Maybe over the last few weeks we've had fairly positive markets. It's been a risk-on environment, relatively speaking. Some people are positive because we've had positive earnings come out of the States. Things in Europe seem to be being solved, at least if you read today's headlines. U.S. elections tends to be positive for the market. The governments tend to want to be do everything in their power to make sure they get voted. So they tend to spend a lot of funding into the market, potential QE3 to try and get themselves elected back in. Why would you be bearish in 2012? I think everyone's more than aware of the bearish views because 2011, the second half of 2011, had many black swan events and many kind of uncertainties which most people believe has ventured into this year as well. So there we go. Are you bullish? Are you bearish? I will let you know my view. In my view, which is largely based on cycle analysis, both time cycles but also economic correlation, is that 2012 will be a football game of one quarter and a second half. Does that make sense to everyone? 2012 will be a game, or a football game if you will, of one quarter and the second half. Now what I mean by that is the first quarter of this year, I think, as we can already see, is likely to be a continuation of positive momentum on the risk market. So positive moves on the Western equity market, such as the S&P 500, such as the euros. We're seeing now a big bounce from oversold levels. Also currencies like Aussie dollar, which represents risk appetite, and some of the other commodity currencies. Gold and silver potentially in the near term may continue higher. But again, I believe this is only for the first quarter. Where am I going with this? The first quarter of this year is likely to be positive, and we can already see evidence of that. The second half of this year is also likely to be positive, and this is positive for risk markets, covering currencies, equities, and commodities. You can think of the risk markets through each of those asset classes. Now, that singles out the second quarter of this year. And according to my cycle studies, the second quarter of this year has a high probability of a strong drawdown, strong bearish downside pressure on what we know as risk markets. So the second quarter of this year may be a disappointment on some of the markets that we're actually quite excited about at this moment in time. Is that clear to everyone so far? The 2012 one quarter and the second half positive for the risk markets which we know and love, such as the euro, such as Aussie dollar, risk currencies, gold, silver to an extent, and of course, most importantly, the equity markets in the West. So basically markets which investors and traders tend to trade the most because they're feeling quite confident about investment flows. Okay, so that's the analogy that I'm painting for you. Now I want to show you on a cycle basis what I mean. This is a kind of theoretical diagram that I'm showing. I've used it before just to quickly explain where we are in this roadmap of financial moves. The big fat blue line is the long-term cycle. The zigzag turquoise light blue line is more medium-term cycles. And then the dotted red line is intraday short-term. So just think of it as multiple cycles which ebb and flow together. Now, short to medium term, just for the sake of this example, is anything from several weeks to several months, up to a year. Long term can be multi-year and often generational long-term cycles, which tend to have big impact on economic and social and even political structures in the countries that we live in. Okay, now where are we at the moment? I believe that the Western economy is roughly there. You have to kind of really focus on the area that I've put that arrow. We're in the down phase of that medium-term cycle, but we're in the up phase of the short-term cycle, the red dotted line. So this is the positive part of the short-term cycle, but still the negative part of the medium-term and definitely the long-term cycle. Is that clear to everyone? I just get a few yeses or nos just to make sure that everyone is okay with what I just said. Okay. Now, in terms of where were we and where are we, 2007 you can probably keep in mind was the very top of that market cycle, and certainly was another kind of black swan event, second to the technology crash that we had in early 2000s. So these were kind of big market shocks which told us that the long-term cycle was very much in transition stage. Then we had the effect of the 2007 financial and credit crisis create a big recessionary period into 2008, and we bottomed in 2009. So that's the medium-term cycle there that you can see in light blue. And of course, since 2009 into the first half of 2011 last year, we were in a recovery stage, which some people were getting quite positive about, and maybe focusing on very strong economic growth probabilities, which some of you may or may not still believe. Okay, but where are we now? 2012 Q1, that's the positive area that I've just highlighted. So that's the short-term up cycle, the red dotted line, potentially where we are at the moment. Where I think we will be in Q2, and certainly into the summer months of this year, which is a very key cycle point for me, a major bottom in most of the risk markets, is likely to be at the bottom of that medium-term cycle within the long-term cycle, the light blue line and the dark blue line. So that's potentially where we could be in Q2. So just keep in mind that we might have some fast-moving markets in the second quarter of this year. Someone's asking, is this an actual figure? These are just theoretical roadmaps that I'm just quickly highlighting, just so you have an idea of what I'm expecting. That's something to keep in mind. Now, after the summer period of this year, that is likely to mark the bottom and a potentially very strong buying opportunity into the second half of this year. Keep in mind what I mentioned at the beginning. If I just go back one step, 2012 likely to be a gain of one quarter and the second half. So these are the positive periods of 2012 in my opinion. The first quarter that we're in and the second half of this year being a potentially strong buying opportunity, but the second quarter is maybe one to watch out for into the summer months where we likely make a major bottom. Okay, now fast forward onto the next slide. Of course, the big problem here is this world of relative performance that we live in, and a lot of people are asking whether, in terms of FX, whether you trade US dollar, Europe, or British pound, or even when you look at the equity markets, which ones are better than the rest. And the issue, the analogy that I've described to many people is this forest fire that the world has basically been in since 2007 financial credit crisis. Each of the trees have been burnt by the fire, and we're basically looking for the best of the worst. Which tree has been burnt the least? And so at this moment in time, the US market, and certainly the US dollar, is looking like the most positive trend. It is already up 10% from its historic lows, and in my opinion, is likely to extend higher, US dollar likely to extend higher, the dollar index, by an additional 20%, up to 20% into the summer months of this year, where it will likely make a peak. All the other markets are likely to do the exact opposite to US dollar, so underperformance against the US dollar. And you're likely to see commodities and equity markets reflect that, an inverse relationship between the US dollar and everything else, basically. The US dollar up, certainly into Q2, into the summer months, in a very substantial way, and most of the other popular markets, Western equity markets, commodity markets, down during that time. So that's a probable roadmap going forward. Now there's a question here: is the length of my long-term cycle change often? Can cycles prolong and short? Yes, absolutely. The cycles that I look at can expand and contract according to the market environment, and I look at various types of cycles in the work that I do. Okay, so that's just an idea of what to look out for. Keep in mind its rotation of risk. So today there seems to be positive news coming out of Europe, and tomorrow it might shift back to the US. Basically, it's past the parcel. We have a gift in our hand, or you can think of a time bomb in our hand, and we've done one of two things. We've either increased the fuse on that bomb, or we have passed it to our best friend next to us, our neighbor, in the UK, in Europe, or in England, and potentially in Asia, if you think of a potential slowdown as the negative effect of this global credit crunch financial crisis that we've been in. So it's a rotation of risk. And in this chart, I've only shown you the US dollar, Europe, and British pound, just in terms of the majors to keep in mind. But keep in mind, the world is pretty much very similar to this picture where the forest has caught fire, and you are looking for the relative outperformer of the rest. You're looking for the best out of the worst. Okay, now that's part one. That's in terms of the year to expect for 2012. I will definitely be organizing a webinar just on my market cycle analysis and go into a lot more depth on my outlook for each of the markets that you care about the most, that you need to trade into this year. But now we're going to focus on the core part of this webinar, which is obviously trading strategies during these volatile times. Part two, we're going to focus on the new resolutions, which I shared with the team at FX Street. It wasn't published on the website, but I'm happy to email it to you, the full content of what I wrote. I'll go through it very basically here. Know yourself, timing is everything, and at all times think risk scenarios. So this is part two that we're going to cover now. Now, know yourself. It's one of my favorite photos of this very cute and sweet kitten looking into the mirror, and lo and behold, they see a roaring, confident lion staring back at them. Now, how many of you in this forum have ever felt like this? You're quite a humble trader and investor, but when it comes down to actually executing that trading strategy, you really kind of get into that emotional state of overconfidence, ego. You're right, the market's wrong. How many of you would admit to that type of psychology behavior? Just out of interest, how many of you want to volunteer and say yes? Overconfidence, belief in your strategy being right and the market being wrong. Okay, so a few people have been very kind to volunteer themselves. Best thing is to actually just acknowledge your strengths and your weaknesses, and certainly that's a big part of knowing yourself. Some of you probably expected this webinar to start talking about statistical strategies and P&L performance and how you can increase your numbers by 3 times the target that you've set yourself for 2012 and so on and so on. And I can talk about indicators all day, all week. But it really does start with yourself. A lot of it is psychology. And it's the first thing to get in order before we even start to talk about any type of strategy. Now, I've written a few sub-points underneath on the right, if you just see, emotions and discipline. Which one are you? Are you an emotional person or are you a disciplined person? Usually, we're one of the two. Or we're heavily kind of favoring on one side. Now, humans are naturally emotional, and what I just want to quickly say is emotion is high and low. One day you're feeling great, one day you're not feeling great. One day you're excited, you're full of energy. Next day you're maybe scared about a trade that you just initiated. You're depressed because maybe you lost some money, unfortunately, and it starts to hit your trading strategy. Someone said, I feel all day that I don't know enough, so knowledge can maybe affect your emotions. I can tell you that in all the years that I've been learning about the market as a humble student of the market, the more I know, the less I know. In my last career experience at a company called Bloomberg, I worked as a technical strategist, basically visiting clients around the world in banks, hedge funds, and various brokerages, trainings and to improve their strategies, but also, of course, learning from them. And I can tell you the amount of information I learned was immense. But it didn't really mean that my strategies would improve overnight. It just meant I had to filter out a lot of information because there is a lot of noise out there. There's a lot of information that is useless. And the best part of experience is knowing what to use and knowing what not to use. But getting back to the emotions, you will have emotional highs and emotional lows. So you just need to be very aware of that and try and find a balance between the two. But be very aware of the fact that you will have high days and you will have low days. The point that I made in the email that I sent to FX Street for New Year resolution, Know Yourself, is that the problem that we face in 2012 is that there is a global social mood cycle that is about to move into a new down phase. You can probably see around you that there's global unrest in each of the countries. It's pretty much kicked off with the Arab Spring in the Middle East, where you have various kind of government changes or revolutions taking place. So big political change in that region of the world. But then, of course, you had protests in Wall Street, even in the UK, different types of protests. And you can see pretty much around the world there seems to be social unrest. And that's very much part of the bear cycle stage that we have been in for some time. And as markets continue to get more volatile and get more bearish, social mood globally will intensify in a negative way. And so we have to be very aware of that, and we have to protect ourselves from that as traders and investors, because as a trader and investor, you need to be very disciplined. And the key point here is, the third point I put under there, is herding patterns. We don't want to become part of the pattern. Think of all of the patterns that you know and trade, like trends that exist, uptrends and downtrends. or consolidation patterns like triangle patterns, head and shoulders patterns, topping patterns, all these various patterns that you've learnt and you've traded so many times, keep in mind that these patterns are made up of market human psychology. And the point that I say here under herd patterns is be careful that you don't become that pattern. Be careful that you don't become that bullish or bearish trap, that head and shoulders pattern, that triangle pattern. It's much better to be aware of what the herd is doing and trade perhaps in the opposite direction, but try not to become part of it. Which market do you mean? Can you be more precise? I will do. I've got examples after here that I'll show. And in terms of discipline, focus on the goal, try and be rule-driven, and adapt to change. I won't spend too much time on that because that's pretty clear-cut. The emotional side is probably a bit more requiring a bit more detail, but I think the discipline is fairly clear. So the better thing to do is to be disciplined, focus on the goal. What is your goal? What is your trading goal? And a lot of that is down to what is your monthly target, what is your yearly target in terms of P&L. What are the rules of your success? What strategy is helping you make a profitable run in the market? Make sure it's rule-driven strategy, and make sure that you respect those rules. You can have some flexibility in the rules, maybe allow some decisions to be made by yourself, but the most successful strategies tend to be rule-driven largely, and I would encourage you to do that. It helps you keep disciplined, especially when the market is very volatile, and potentially if you become very emotional in that market environment. What is very important is to, at the same time as being rule-driven, to adapt to change. You must be able to change as the market does. And this is very much how people and animals in the world survive. It's survival of the fittest because of the ability to change, to adapt to change. Not because you're strong, not because you have lots of money in the account, but because you're able to adapt to change. Okay, so just keep that in point, and I'll move on to the next point. So the first point was know yourself. Are you emotional? Are you disciplined? Can you be both and understand yourself as much as possible in order to be successful in your trading strategy? Second point is that timing is everything, and certainly in life and in the market this is so true. But let me tell you what that means. In terms of market characteristics, these are 4 different market environments that you probably already can identify with. And each of the market environments symbolize high volatility or low volatility. Chart 1 and chart 3 are low volatility environments. So chart 1, as you can see there in the top left corner, is a trending market, an uptrend, with low volatility. You can see the corrections during that uptrend are quite small, that they're easy to trade, and you can get it wrong a few times but still make money. Maybe use a few moving averages, maybe use that wonderful phrase, let your profits run, and cut your losses quickly. But look at chart 2 and chart 4. Chart 2 and chart 4 on the right-hand side of the screen are markets, trending and non-trending, with high volatility. Now, just focus and think to yourself, the markets that you trade, Eurodollar, Aussie dollar, S&P 500, gold, silver, just think of each of the markets that you trade every day, and how volatile is that market? How many times have you been stopped out of that market? How many times did you think the market was going to break to the upside, and you just got chopped out of the market and it pushed the opposite direction? That is the result of volatility. How many times did you think a pattern was forming and the pattern just completely flipped the opposite way? Or an indicator gave you a signal, and then the signal just basically failed an hour later or several days later. Can everyone relate to what I'm saying here? The impact of volatility to your day-to-day trading strategy. Can I get a few yeses or nos? Everyone can kind of understand where I'm coming from here. Now, this is really important because if you accept that we are still in volatile times, you have to accept that the changes that need to be done in order for us to survive. Only the best of the best will survive markets like this. You might be positive today, but hey, there might be a big move tomorrow on the downside. So what I'm saying applies to every single day that we trade in this year. And the message of what I'm trying to say is volatility is very difficult to trade if you're not used to it. And certainly the volatility that we've seen in recent months and recent years has been historic volatility. We haven't seen volatile markets like this for decades, if not even longer than that. So that's one part of what I want to say about timing is everything. But the point about timing is everything, the other part that I want to focus on in terms of trading strategy, the markets that we trade now, because they are so volatile, you need to change some of the mantra, some of the trading strategies that you've kept in mind. And one of the ones that I really want to stress here is that, first of all, focus on timing. Focus on swing trading strategies, like, for example, candlestick patterns, like, for example, counter trend moves in the market. So the trends are your friends, but keep in mind that the trend can end. And this is one of the reasons why, for example, I use DeMark indicators, which is a proprietary indicator that I mentioned at the beginning, which looks for turning points in the market. Also why I look at cycles, because that, again, focuses on turning points in the market. Another reason why I use candle patterns, because that mainly focuses on turning points in the market. Most of the candle patterns that exist, out of the hundreds of candle patterns that exist, are reversal patterns. So focus on reversal counter-trend type strategies, because they will allow you to know when your strategy is about to fall off the cliff, when you're about to get a big drawdown in your account. You can trade with the trend, you can trade against the trend, that's up to you. All I'm saying is try and have a timing element in your strategy where you're able to know when that strategy is about to go the opposite way, go against your strategy. Okay, is everyone clear on that? Have a timing element in your strategy. And so if you're a trend follower or if you're a counter trend type of person, doesn't matter, that's up to you, it's up to your trading style. But what's most important is have both of those in your trading setup. Identify the trends, but also identify the turning points within the trends or the reversals of those trends. I personally use a lot of market timing, and that's partly why I look at cycles, candle patterns, and DeMark indicators, just to mention a few things I specialize in, because it really harnesses market timing, and I find that it gives me an edge during these volatile markets. The last point I want to make about timing is this old mantra about let your profits run. How many people agree that it's profitable to let your profits run? And obviously there is some truth to that when you're in a successful trading position, you don't want to cut that position because you might make even more money in that position. So why would you limit your gain? But how many people agree with that statement? Let your profits run. Can I get a few yeses or no's? How many people agree with let your profits run? So one person saying yes, it is possible. I just don't know how to implement a strategy. Agree. Yes. So there's most people agree. The one person saying no, and I actually want to support the person who just said no, just for a moment, just to play devil's advocate for a moment. The markets that I've been trading, certainly in 2011 here at MIG Bank, have been pretty volatile and pretty fast. And so by definition, I might be following trends, I might be looking at turning points, whichever strategy I'm doing. But what I've discovered in last year, more than any other year, is that you need to be very fast. Sometimes you need to really just be very nimble, jump in the market and jump out very quickly. And like someone just said, have a break-even stop and then let it run. So you just either need to be very active with your risk management and money management, or you just need to be very conservative with your profit target and just literally jump in, jump out, or, as the person just said, have a very smart, active risk money management strategy. But the point that I'm trying to say here is letting your profits run isn't the secret to having a successful strategy in 2012, because a lot of the time the volatility will eat away at your account. So you really need to be aware of that. Now, someone just said it depends on what you're trading, what time frame. Totally agree with you. The market that you're trading matters, and the time frame you're trading matters. But just as a rule of thumb, keep in mind that the changes in markets, be it euro dollar or gold or time frame 15-minute chart or a daily chart, keep in mind that volatility is affecting all markets and all time frames. So we really need to start adapting our strategies accordingly. Okay, so that's timing. The next point, my third point in terms of New Year resolution, is think risk scenarios. Now this is a statistical probability distribution that you're seeing here, which is actually the probability distribution that most people use for explaining how financial markets work. Not the efficient market hypothesis, but the updated version, which is a better reflection of the markets that we trade. Now, the reason why it's a better reflection of the markets that we trade, because the tails of this probability distribution, the long end of this red line on the left and on the right, are quite wide. And that allows for a lot of market shocks. And of course, we are in a world now where we're getting regular market shocks. Some experts have called it a new normal, where we seem to have many unknown knowns in the market. And of course, what that does is create a lot of positive and negative volatility, a lot of black swan events. But we need to actually hedge for these types of events as much as we can. And so the point that I'm saying here in terms of think risk scenarios, I would encourage you to think in terms of multiple risk scenarios. And my favorite saying, look at both sides of the trade. If you're bullish today, what would make you wrong? If you're bearish today, what would make you wrong? Have that turnaround level that allows you to quickly change that view whenever you need to. And think about the risks out there. So some of you who are listening to this from a macro view, some of you who believe 2012 is a positive year because of the European crisis might be contained, or because the US election might be positive for the economy. Asia might have a great growth cycle into this year. All the reasons why you might be positive from a macro perspective. Think about, what if you're wrong? What if contagion in Europe gets worse? What if the presidential cycle doesn't work this year and they're unable to really stimulate the economy? What if Asia has a slowdown or a hard landing? Think of multiple risk scenarios, technical and economic, and nowadays political. You need to be thinking about all of these three things at the same time. Okay, now how can you do this in terms of a real example? One of the very basic examples that I encourage my clients to do is to just, for example, use standard deviations on your chart. There are many other things that you can use to hedge multiple risk scenarios on any market that you trade, but standard deviations is quite an interesting way to do that. So standard deviation or regression analysis is a good way to do that. And here you see a chart of Eurodollar. This is an up-to-date chart. You can see the obvious downtrend we've had for several months and the recent bounce that we're having from very oversold levels, trading around 130.40 when I last updated this chart. Now, the red dashed line is the average mean where Eurodollar has been oscillating for several months, and we're testing that mean at the moment. The gray line is either +1 standard deviation or -1 standard deviation. So straight away there you have multiple positive and negative scenarios that might happen on Eurodollar. And the green line is +2 standard deviations or -2 standard deviations. So is everyone kind of clear on just a very basic example how you can maybe think in terms of technical risk scenarios, positive and negative? Okay, so think risk scenarios, technical and economic. But this is an example of technical. I've already kind of explained maybe economic ideas. The problem of 2012 is that a lot of people are on one side of the trade. And I really think that that's going to catch out a lot of people. A lot of people that I respect, Catches me out at the best of times, but also people that I know in the market, industry colleagues of mine, are also doing that, and various commentators are also doing this. So this is not the year to have an absolute certain view in the market, because I think the biggest call this year is just hedging yourself for various likelihoods, various probabilities. I don't think there's anything certain about 2012. That's my long and end perspective. So think of risk scenarios, standard deviations, or regression analysis is quite a good way of doing that. Okay, part 3. This is last part, and I'm going to try and go through this quickly so that we can finish in time. Pyramid analysis. Just very simply, we're going to focus on 3 steps to improving your analysis into a volatile market of 2012. The pyramid analysis is this picture here that I use in most of my trainings whenever I'm training clients. Just think of a top-down approach. You start with the macro and you drill down into the micro. The top part of that pyramid is the most important part, and that is your trend analysis, or as I like to call it, cycle analysis. What is the roadmap that you're following in the market? Think of yourself as driving the car, and you have a map in your hand trying to navigate the financial road ahead in terms of your trading and investment strategy. The trend analysis or cycle analysis. Key levels. What are the key levels that you're following? Are they psychological levels, highs, lows, Fibonacci levels, Gann levels? Indicators. There are so many indicators. Most people actually like to focus on indicators the most. I actually think that's a big mistake. Indicators are important, but they are not as important as the price itself. You've probably heard people say this many times. And when you focus on indicators, think of groups of indicators, not the hundreds of indicators out there that create a lot of noise. Think of groups of indicators that you can use in a non-diversified way. Now, I'm going to quickly explain what the pitfalls of some of these areas, trend analysis, key levels, and indicators in a volatile market. So think top-down analysis, pyramid. The most important part of the pyramid is the top part, trend analysis, cycle analysis, key levels, and then indicators. Now, popular analogy in the market is that the trend is your friend, and there are many studies on this that you can read about, that trading the trend can make you the most profit. Some people agree with that, some people disagree with that. I think it's all about how successful you are in applying either of those strategies that matters. But the point I want to make about the trend being your friend is that is true until it ends. And certainly, the last few months, we have seen this many, many times. And this chart here that I'm showing you is a chart of silver. And you can see that I put in silver. I mean, there are many examples I could have used for trend changes over the last few months and years. But silver, I think, is a fantastic example, because the sheer acceleration that we had on the upside, which was in the end unsustainable and created a crash, 2 crashes, was a great lesson to everyone that just got so bullish or so greedy and so leveraged on this silver metal. Now, keep that in mind and let that be a lesson to all of us, that the most beautiful trends do end. And when they do, it's a major capitulation event. And the very fact that it looks like a great trend means that a lot of people are trading it, and that maybe a lot of people have leveraged in that trend. And even worse, maybe at the top, when everyone is buying and there's no one left to buy, that creates a vacuum. And by its very nature, that creates the reversal. Now, the reversal gets very ugly, mainly because of margin calls. Everyone is leveraged on that market. Everyone is buying that market. And then one person gets a margin call. And that just creates a domino effect on the downside. And literally just people end up deleveraging and closing a lot of their positions across the board. And every market in the world becomes correlated during that time. Keep in mind that silver, as an example, had a crash on 2 occasions last year. Spring of last year and then summer of or early autumn of last year. The first time that silver crashed, it crashed 30% in 1 week. Think about that. 30% in 1 week. I'll say it one more time. 30% in 1 week is a huge move. The second crash was about 20% 1 week. And someone's saying here, Ron, is copper the commodity that reflects how well or badly world economies are doing? Yes. There are various leading indicators, leading market indicators that I look at. Copper is one, lumber is another, and also silver is a great indication for economic health of the market, the industrial health of the market. So yes, these markets having toned down a little bit, and oil is another. So these are key leading indicators. Okay, so silver is a great example of the trend being your friend. You're making lots of money on the upside, but keep in mind until it ends, you get that major capitulation phase, and silver is a great example on that for last year. Key levels. Now remember in that pyramid, first part was trends, second part was key levels. Key levels, I'm not going to teach you how to trade key levels. Everyone knows how a psychological level, like $100 on oil, like 140 on euro-dollar in this example. So these are round numbers or psychological numbers that everyone in the market is following. They're quite emotional about these levels. Keep in mind that a lot of these levels can be broken in a very volatile way, and they can create false breakouts, otherwise known as bull or bear traps. And euro-dollar did this quite a bit. You can see here the famous pattern, triangle pattern that euro-dollar was in 2012. People were calling it the triangle pattern. I called it the Bermuda triangle pattern, where you're more likely to get false signals and lose your money, similar to the analogy of boats getting lost at sea in the Bermuda Triangle. And you can see there where the red arrows are, there were lots of false breakouts from this Bermuda Triangle on euro-dollar, which inevitably result in the downside. So be aware of bull and bear traps. Try not to become them. When you get these false signals, they are great trading setups, but you need to be on the right side of that trading setup in order to make money from it. Whenever the market has reversed itself, that creates a fantastic setup on the opposite side. So that is actually a great trading strategy for this year. Look for false breakouts, look for bull and bear traps, because these are great emotional reactions in the market that create sharp moves in the opposite direction. Okay, another key level, remember I mentioned, was on oil. So this is a recent chart of oil on West Texas oil. I bring this up also because of the news that came out of Europe today about the potential Iranian oil embargo likely to take place into summer, July of this year. And notice that the rise that oil has had is running into pressure around that $100 mark, which is also the golden ratio, 61.8% retracement of the previous decline. But the point here I'm making is oil did not stop at the $100 mark. It moved up, moved down, and it's just basically been oscillating around that level. Sometimes these key levels, these key psychological levels, are not exact. The market just maybe flirts with that level, or it oscillates around that level. So keep in mind that levels are not there just to stop the market or to make the market kind of accelerate in a particular direction. Sometimes the market just oscillates around that level. So you can see that the $100 mark on oil is still important, but it's not an exact number, not an exact level. And so someone's just quite rightly said it's a zone, it's an area. So I've highlighted here a trading range on oil, and within that trading range you can obviously see that it seems to be attracted to the $100 mark, which is also the golden ratio level on oil. So $100 on oil is important, but notice how it's a zone. It's an attractor level, where price is magnetized to. So it's not exactly as the textbooks teach us. Markets can be volatile and move up and down around these key levels, be it psychological levels, highs, lows, Fibonacci levels, whatever it might be. Everyone clear on that? We're running towards the end of the webinar, so I just want to make sure that everyone is okay. Everyone okay with key levels? Okay, so what I'm saying is all the key levels that you know and love in trade, and you've learned it from all the technical analysis books, just keep in mind it's not exactly how it's taught, and key levels can be zones in the market, so between different numbers, The market can oscillate around those levels, and in some cases, it either a good level can stop the market move, or it can accelerate the market move. I haven't got all the examples to show you here, but hopefully you can follow what I'm saying and visualize what I'm teaching here. Okay, my last slide is exit strategies, and we've mentioned some of this. To be honest, I think the most important part of a successful strategy this year in 2012, and what is likely to be a volatile year, similar to 2011, maybe more, is your exit strategy. It is better to be out of a trade than in a trade that you're not comfortable with, and I really believe that. So exit strategy is probably, I would say, more important than your actual profit target strategy. Exit strategy, control your risk. If you can just survive for the next trade, then you've done well. That in itself is a successful strategy. And so I've just written a few points to keep in mind in terms of different types of exit strategies that you can keep in mind. Technical stops, beware of round numbers. A lot of people in the market, also in FX, feel that using round numbers, psychological levels, is good when you're putting a stop loss level in the market. It's actually a very bad idea. Please do not use round numbers, psychological levels in the market. It's my personal opinion that you're more likely to lose money that way than survive for the next trade. A lot of people are looking at the same levels that we're looking at, especially the large institutions or the large players in the market, and it can be quite detrimental to our health as traders and investors to use round numbers as technical stops. So it can be a round number, or it can be a major high or low in the market. It might even be a Fibonacci level or a support resistance level. Try not to use exact levels because a lot of people are following the same thing. Financial stops, just very quickly in the last minute. Money management, I really encourage kind of tying it in with your money management. Volatility stops, I'm a big fan of. Know the volatility of your market. What is the market behavior? And try and factor that in when you're using stops. So if the market's trading 1,000 points in a day, don't use a 10-point stop unless you have a very high conviction on that trade. Otherwise, it's better to use a stop loss level which reflects the volatility, the true volatility of that market. I use average true range as an example. And then lastly, break-even stops, as it was mentioned here. If you're in the money on a trade, you're making profitable trade, make sure that you raise that stop or lower that stop to your break point, so that you have locked in the profit and made a risk-free trade. Okay, hopefully that's clear to everyone. That's the end of the webinar. We're out of time, but also we've finished in time. Part of my New Year resolution to be better with my timing on these webinars. And my mantra each webinar and throughout my career has been enlightenment through realized knowledge. I really believe that we all learn from each other, and I really encourage that. Just a quick reminder that the next webinar is 13th of February at 4 o'clock GMT, and that is on the oil outlook and price risk amidst heightening geopolitical tension. Oil outlook and price risks amidst heightening geopolitical tension. I gave a CNBC interview this morning, which I'll send to some of you guys if you just email me at the end, talking about the effects of what happened today about the EU-Iranian oil embargo and what that might mean for markets. So just keep in mind there in the yellow section, big picture, what does oil market suggest? Geopolitical update, what does the EU-Iranian oil embargo mean for the market? Key indicators to watch. I'm going to let you know about key market indicators to watch as the geopolitical situation changes, and what volatility signals suggest about upside price range on oil. Thank you very much for your time. It's been an honor and a pleasure. This is Ron Williams, technical strategist at MIG Bank, based in Switzerland. If you have any additional questions, please email me on r.william@migbank.com. MIG Bank is on Facebook. I'm on Twitter on rwilliam77 and LinkedIn under Ron Williams. And just finally, questions, charts, that I've shown, or if you would like just follow-up research that I write, please just send me an email. I'm happy to send it. Look forward to seeing each of you on the next webinar, Oil Outlook and Price Risk Amidst Tightening Geopolitical Tension, 13th of February, 1600 GMT. Thank you very much. Take care and Happy New Year, everyone.